Last week, we went over minimum funding, overfunding, and max funding a cash value life insurance policy. This week, why paying cash might not be the most efficient way to handle your finances. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Net Wealth Finance.
All right, paying cash, not always the most efficient method. Might seem a little bit counterintuitive because people love paying with cash for some reason. But what does it cost you if you're going to sit around and hold on to cash while you're waiting to buy something?
Yeah, I think that's one big factor where a lot of people don't necessarily think about that opportunity cost of parking away that cash. Maybe you're saving up and it's sitting in a savings account that's maybe earning 0.1%. Maybe in a good day, you get a high yield savings. It's earning a couple of points, but it's not super consistent maybe. And what are you missing out on? Is it invested in the market? Could you be getting 4, 5, 6, 7, 8% possibly with those funds? So whatever it is that you're looking to buy and you're saving up that cash, if it's not efficiently earning money while you're saving up that cash, then you're really kind of missing out on something.
Yeah, so we can come at this from a couple of different angles. When you're ready to buy something, do you pull it from cash that's readily available in a checking or savings account, or do you borrow the money from somewhere else? Could be a line of credit, could be a credit card, could be a cash value life insurance policy. It could be a brokerage account. It could just be you borrow money from the bank in order to make the purchase. There's all kinds of decisions that somebody can make at the time of a purchase. And I would argue in that instance right then, using cash is the most efficient thing to do if you have it. So if you're sitting on the cash, clearly that is the most efficient dollars to use as opposed to borrowing other dollars when it comes to strictly looking at efficiency. But outside of that immediate moment, we have to consider, what were our dollars doing? What were we doing with those dollars while we were waiting to make that purchase decision? That's where you were talking about, if you're saving it in a high yield savings account, doing something to earn interest.
Yeah, and I think that's the big thing. And I also connect this to when I'm thinking about this. If you are paying extra on a mortgage where people are trying to pay off their home and have a paid off home, well, you're locking that in equity jail. If you got that cash and you did buy that home, all cash, there's a lot of cash that is locked up in that. Yes, it's appreciating at maybe a few percentage points, but what if you were paying, well, in my case, a very low interest rate? I'm one of those people who had nice refi when interest rates dropped. And so I have no reason to pay off that house. And the funds I can easily earn, well, in my whole life policy, it's pretty much as good as guaranteed. Actually, the guaranteed rate is higher than my mortgage rate. So that's the thing, is when you have this ability to lock in some compound interest gains on the whatever it is where you might have used cash, then I think that's where that opportunity cost and the less efficiency in overall wealth growth. It's not the purchase efficiency, it's that overall wealth growth picture if you don't have unlimited funds.
Yeah, so let's flip this a little bit and let's step back or reverse time. Where do we want to sit on our cash? Like, I call it equity. Where do we want to store our equity? If we consider cash our equity, do we want to store it in a checking or savings account? A lot of people do that as their emergency fund, and it's just not that efficient when those dollars might be doing almost nothing for you other than providing liquidity in the case of a checking account. And in a savings account, even a high yield savings account, it's only giving you a very small taxable gain from whatever the rates are for high yield savings accounts, which right now they're okay, I guess, mid 3% range. But over the last decade, they were almost zero. Even in a high yield savings account, you couldn't even really push 1%. So it's challenging to say long term that it's efficient to store your extra money in a checking or savings account.
Yeah, and then to take that even a bit further, I'm one of those people who pays cash for, like, almost nothing. If I can avoid it, I put it on a credit card that I pay off every month, or if I have a 0 interest offer, I'll be letting that balance ride until then. I mean, that's a really efficient way. If you have a 0 interest credit card that you can have float 12 months, 18 months of expenses and just pay it off once, you're about to have interest on that, then that's super efficient, and you're able to deploy funds elsewhere. And then on top of that, I don't know, that's what I consider myself kind of points and miles light, but I still have, like, I think over 1,000,000 points in total across my different accounts because I just choose to pay with things that earn me points.
Yeah, I guess we didn't even discuss this part before we hop backwards, but instead of paying cash, if you can use a credit card and it doesn't cost you more than the percent you're getting in rewards, it actually is more efficient to utilize the credit card. Not to mention, you get to float the use of somebody else's money for free for 30 to 60 days before you have to make that credit card payment. This is where we practice dynamic banking or velocity banking. And while that money is being floated, we have that cash actually sitting inside of a line of credit offsetting interest. And then when we pay the card off each month, we're going to pull it from that line of credit to pay the card off. So we get the rewards points, we get the free float, where if we had just paid the cash for the bill, we wouldn't have it offsetting interest on a line of credit. And then in this case, we get that savings on that offsetting interest. So the savings just add up when we utilize those three things together instead of paying cash to make a purchase.
Yeah, and I think that can really end up paying dividends over the long term because it can be pretty minimal effort to do what James just described, and he's got some great videos on these concepts. So it is important to note that when you are paying cash and you have like automatic interest-bearing accounts, and you're not using credit cards to float expenses, you're missing out, basically on, covering 30 to 60 days of interest elsewhere at various points and averaging out to that. So it is a powerful thing because that is, these credit card lines of credit do give you that kind of free float that you get with that paying off the statement balance. That's the important thing. You always have to pay off the statement balance unless you have a 0 interest offer. Pay off that statement balance every single month.
Definitely got to pay those cards off. You never want to pay credit card interest rates. Now, let's step back to what we're doing with our cash before we're ready to make a purchase. And this is getting back to where do we store that equity? This is the Life Insurance Financial Education Podcast. We're huge advocates for storing that money inside of our life insurance, our cash value life insurance. Now, you can certainly put it into other investments. There are things you can do for that. But let's specifically talk about what I know you and I both do and what a lot of the infinite banking space argues for, which is storing that cash inside of our life insurance.
It is one of the best places to store it. There, other than your health underwriting, you don't have any underwriting to get access to your funds. So if you need them, you can get them. So when you store funds inside of a life insurance policy, it is pretty close to cash. It's not perfectly there because usually it's a few days, but I've had funds clear in as little as 2 days on policy loans. So, and if you do have, maybe an insurance-backed line of credit with an external institution, they could have funds clear much faster, ready to pay bills. So there are ways to really make this very efficient. And then you're building equity inside of these life insurance policies. That cash value that you have growing is constantly also growing. It has that as you put premium in, on the whole life insurance side, you got those dividends. On the IUL side, you can have the index credits, and it's a really powerful thing that your cash will grow over time in these policies.
And by storing our cash inside the policies, we're getting multiple benefits. Right then, we've got the death benefit. Almost every policy has living benefit riders. So if we end up not being able to do 2 out of 6 daily living activities, or we become diagnosed with a terminal illness, like we have access to cash, more cash than what's available in the cash value, potentially up to the full death benefit before we even pass away. Those are just the perks of storing our money inside of those policies. And if it's an efficient design policy, the expenses are going to be very low. And after a few short years, we're going to have more money available inside these policies than we've paid into them. And at that point, we're using house money. This is money we would have otherwise been sitting in a checking or savings account, not doing hardly anything. So if we can start earning more than that and get these extra benefits, that's efficiency right there.
Yeah, and I think that's where the concept, this infinite banking concept, it really shines because you, along with having this nice vehicle for storing funds, having nice, pretty safe returns in them, you got all of those extra perks that come along with life insurance. And I kind of think about it like this from the perspective of my life insurance. At some point I have like one small term policy that I still continue to pay, but that's always a liability or until the term ends and then you don't have that coverage anymore. But once you've funded this and you've kind of hit that break even point in your life insurance policies, it's almost like it's free life insurance, but it's still your line of credit that gives you all these extra benefits. So that's the way that I like to think about it. It's not technically free. There's still insurance costs. It's just the insurance policy itself, the cash value in it, can very quickly get to the point where it is covering its expenses and beyond.
And while the cash is sitting in our policies, it's growing and compounding tax deferred. When we access that cash value, we're also going to access it tax free using policy loans. And the policy loans are generally going to, at most, come at a small net cost. We will generally see a net cost maybe between 0.5% and 1%, depends on if you have a whole life policy or an IUL. And sometimes you might even be able to get some small positive arbitrage between what you're paying and what you're earning on the cash value that's still in the policy. So even though we're accessing it, we're just collateralizing that cash value. We're not actually pulling it out. And so it doesn't stop the compounding. That just increases the efficiency of what we're doing with these funds. And when we repay them, it works just like a line of credit. So that money's available again to borrow. So if you're using this policy as like an emergency fund, well, if you have to tap into the emergency fund to go make a payment for something, what do you need to do? You have to replenish the emergency fund after that. So in this case, you would just pay that loan back. And then you're back to growth and compounding without any type of interruption or even that reduction due to a small net cost on a policy loan.
Yeah, and I think that's the thing. It is a great place to park your money. If you have to tap it, you can pay it back and have it ready to deploy elsewhere. So it is really powerful. And I think, this is probably a good point to bring up that there are other options that you can do this with. And people do, for example, keep a HELOC ready. And it's not a bad idea to have a HELOC, a home equity line of credit, ready to go for emergencies. But here's where that breaks down in the financial. Actually, I was just having a discussion yesterday with one of my friends about this. I know I'm kind of weird. I just have discussions about these sorts of things, but the private money stuff it's drying up. I think the like former head of Goldman is talking about this. That it smells a lot like 2008. We might be seeing people or institutions cutting off their lines of credit, the HELOCs, maybe lowering limits. A lot of these types of things happened in 2008. I'm not saying I'm not a fortune teller. Like I don't know exactly what's going to happen, but these things are possible. That is not a possibility when you have a contractual obligation inside of whole life or IUL to access or be able to access your funds.
Yeah, you got to be careful. If you're using a personal line of credit, a business line of credit, a home equity line of credit, if you're using something like that to have the liquidity that you need, if you're practicing velocity banking or dynamic banking, you've got to be careful if the lenders start tightening up. That is the only risk with those types of strategies, is that we really have to be aware of that. Especially if you're doing paycheck parking and you're just dumping all of the cash you would normally be sitting on into these lines of credit. It can mess up your plan if suddenly the bank says, I know you just made a payment on that, but we're capping. You have no more draw period on this line of credit. You now have to just keep paying it off. That can hurt. So be careful with that. That does not happen with your life insurance. The cash value life insurance, you have a contractual ability to borrow against the cash value of that policy. Now, there is a small caveat there. While we traditionally see those loans paid out within 2 to 6 or 7 days, they do have the ability to wait 6 months to send that loan payment out. That doesn't generally happen, but that's essentially the safeguard that life insurance companies have in the event of what would be like a bank run. There's no such thing as a bank run happening with the life insurance companies because they're not banks, but they also have the ability to delay sending out those loans, which gives them time to get the funds together. And the problems with a bank run is banks just get overwhelmed. They're obligated to put out that money immediately, and people expect it right away, and they can't access it. So you don't get those same types of problems with life insurance. But just be aware, contractually, they could wait up to 6 months to give you that loan. Although I've never seen anything in that regard when people have needed their money.
Yeah, and I think that is a really good call because you got to be aware of that. And like I haven't seen that happen either. But the scenario that protection is there for is much bigger issues. Like I don't know, it's mass casualty events that they're paying out giant amounts of death benefit in, or something like that. And there's a financial crisis going on. So like I think it's a very unlikely scenario that they're going to be pushing that limit, but it is possible. It's good to be aware of. We did have a prior episode where I think we did mention there's this Mass Mutual blog post about what they did. I think it was in Detroit in the Great Depression, where they actually trucked in cash when people were the bank runs had happened. Mass Mutual trucked in cash for policyholders to be able to get access to their funds. So when everybody else is in disaster mode, Mass Mutual was probably hurting too to some extent, but it was there to backstop its clients in their time of need at that crazy time.
All right, I think we made a good case for cash not always being the most efficient. Certainly, within our budgets, we like to do what we call dynamic banking or velocity banking, cycling that money through lines of credits so that it is the most efficient, and obviously using credit cards to get those rewards points. We'll do more on that in future episodes, so be sure to stick around or check out our personal YouTube channels where we definitely have lots of videos talking about the efficient movement of money. Next week, we're going to talk about cash value life insurance as a volatility buffer. There could be a lot of risks being all in the stock market when it gets to retirement. There's a ton of value in having a volatility buffer. More on that next week. With that, my name is James Barber. I'm your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.